Hello, welcome to Let's Make a Profit podcast. My name is Rebecca Howell. I am owner and operator of Custom Bookkeeping and Accounting Solutions, an enrolled agent with the IRS, and also a certified Profit First professional. So this podcast was really designed to be informational on the Profit First method, the highs and lows of being a business owner, and really owning your financials. And the last podcast I did was really kind of opening up on owning your financials, and I'm going to carry that into today as well. But the U.S. Bank had a study said that most 83% of all small businesses run check to check. So with those statistics, it's hard to be a business owner. It's hard to really understand your financials and understand what those financials are saying to you and how you can learn from them and become better business owners so that you're not part of that 83%. And Profit First, being a cash flow management system, is really designed to help you get out of your entrepreneurial poverty and living paycheck to check, check to check, and really learning how to understand how your money flows in and out of your business, and really taking that money and benefiting you from that perspective. So before I dive in too much today, I want to thank my sponsors, Dr. Bo and Jamie Mullen and their staff at Harbor Life Chiropractic. They want to help you in unleashing your health potential. Tim and Sadie Marlowe at BD Local Podcast Studio, thank you for all your hard work in making our podcast great. Roger Sargent with Affluence Business Solutions, helping the small business owner and their teams with their business development and leadership skills. Thank you for all my sponsors. I do appreciate each and every one of them. So last week, I talked about, really owning your financials. And again, I'm like I said, I'm kind of carrying that over into this week's podcast. But as a bookkeeper and accountant, it comes natural to me to understand the numbers and how they affect everyone and everyone's business. But I also understand that, as I've worked with clients over the last 18 years, that not everybody feels the same way about numbers. And I used a book last week, and I'm carrying some of that again into this one. The book was Accounting for the Number Phobic, a survival guide for small business owners. This book was written by Dawn Fotopoulos. She has a really great way of explaining your financial statements, your numbers, again, how they affect you. And the book is actually very interesting to read. And even somebody like myself, I find a lot of interesting information in it. And it was just a really easy read. And she puts a little wit into it. There's a little bit of wit to her personality. And she just has a nice, fun way of explaining sometimes some of those numbers. So if you feel like you're afraid of your numbers, this would be a good book to start with, and really getting a better survival guide of how to be a business owner and owning your financials. So experts such as banks, consultants, even accountants agree that most small businesses fail not due to undercapitalizing their business, borrowing from investors, borrowing from lenders, banks, things like that. It's not your capital that is actually hurting your business. It's really your management ignorance. And I don't mean to call that a rude statement, but because you don't know what you don't know. So that's where the management ignorance comes in, is that sometimes you don't always know what the questions are to ask because you don't really know what are the questions. So understanding your financials and having a good pulse on your numbers is key to any business and its success. So many business owners might assume that their numbers and their financials are really their bookkeeper accountant's problem. And they'll bury their heads in the sand and say, I don't want to pay attention to this. It's not something I want to pay attention to. It's not something I like doing. And I understand as a business owner that there's a lot of things that we don't like doing, but we still have to do them. And I think that if you have somebody like a bookkeeper and accountant that is processing your numbers, processing your bookkeeping, processing your financials, but you're having conversations about your financials and understanding them in a deeper level. That's what I'm talking about by owning your financials. I'm not necessarily saying, hey, you have to get into the nitty-gritty of your bookkeeping, because that's what bookkeepers are for. And that's their job. And they do a fabulous job at it, and let you worry about running your business and again, appreciating your why. So Dawn refers to the, in the book, she like this, again, here's her wit that's coming out. She refers to accountants and bookkeepers as the same reference as your car mechanic. Your mechanic is not going to drive your car for you, nor is your bookkeeper or accountant going to drive your business for you. It is your sole responsibility to make sure that that business survives and it's successful. But with the back end people, your consultants, your bookkeepers, your accountants, your mentors, your educators, those are the people that are going to help you be better at your business. We're there to help guide you, give you guidance, give you accountability, and really help you through this process so that you're not in this business by yourself. Because a lot of business owners, we feel like we're alone. And sometimes it's hard to even admit that maybe this is an uncomfortable area for you and ask for help. But once you've made that commitment to say, hey, I'm not comfortable with this. Again, I don't know what I don't know. And getting the help from the people that can guide you and hold you accountable, you'll realize that you should have probably made that decision a lot faster. And a lot of business owners that I work with, they're thankful when we take care of things, when we hand them their documents and say, here, it's taken care of, I just need a signature. So that's really, it's a lot of that you get when you're working with bookkeepers, accountants, consultants. Again, the list goes on and on. So her analogy in the book, and I shared this last podcast, but I also brought the little graphic that I had shared. So she refers to your financial statements as the same as the 3 gauges in your car. And your income statement, also known as your profit and loss statement, it looks like your speedometer, or she treats it like your speedometer. Your cash flow statement as your gas gauge, and your balance sheet as your oil pressure gauge. So when you understand the importance of these gauges to your car and can correlate that same importance in your financial statements, again, kind of putting a lighthearted spin on it and just making it say, hey, these are important things to keep my car running. These financial statements are the same exact importance in making sure that your business is running successfully. So I understand that it might sound funny that I'm bringing a car into my conversation, but again, when you can take a reference tool and understand the importance from one and it carries over to the importance in another, it hopefully will help bridge that gap of understanding that these are important and that you shouldn't fear them. You really should not fear your financial statements, because they are going to be something that is going to drive your business to be successful, and you get out of your business what you want to get out of your business. So some people might say, what are financials and what do they tell me? Financial statements are the company's formal records that show the company's financial position and performance over a period of time. Today, I'm going to concentrate on one of the 3 financial statements that we've been talking about, and it's going to be the balance sheet. The balance sheet boils down to, what is your business worth? This financial is a rolling report from the first day the business opens to the day that the business no longer exceeds to exist. So the day you close it, the day you sell it, whatever your lifespan of that business is, your balance sheet is going to be an ever rolling report from the existence of the business. This report consists of assets, liabilities, owner's equity. Are your assets more than your liabilities? Or are you the other way around? Your business has more debt than you have assets. Can you even answer that question to me at this point? Do you even know what your assets are and your liabilities? Can you answer whether you're one way or the other? If you can't, then you certainly need to be talking to somebody. Do you have past positive or negative net worth This will affect businesses differently depending on really what is your game plan? What is your exit strategy? What is your long game? How long do you plan to be on this business? In this business, how long? Do you want to sell this business? Having negative and positive net worth will affect you throughout the business's life. And certainly when you're getting to these points in your life where maybe you want to sell that business, if you have negative net worth in your business is not going to sell. And it's certainly, if it does sell, it's certainly not going to sell for as much as you expect it to. So your end game is always to try to get to profit or positive net worth. Your bankers will also look at your balance sheet and understand if you're at positive or negative net worth. And it has a very big effect on whether they will lend you money or they'll tell you no. And it's harder to get funding when you have negative net worth. There's also a tipping point in a business where you might get so much debt heavy that you may not be able to ever get out from underneath of it. And that's a horrible situation to be in, because then you're literally, the only option is bankruptcy. And whoever really wanted to get into business and then turn around and bankrupt the business? It happens. I've seen it. I've seen, parents start businesses and then they sell it to their, or give it to their family members, their sons, their daughters. And because nobody was there to guide them and help them through these processes, they drove the business into the ground. And you feel for those parents, you feel for all that sweat and tears that those people did for years. And then because somebody just had management ignorance, they couldn't sustain that business. So I'm going to spend a little bit more time breaking down the balance sheet and explaining to you what each one of those assets, liabilities are. Assets are what the business owns. So this could be your cash, your bank account, money markets, equipment, inventory, buildings, receivables. There are both current and fixed assets under the asset portion. Current assets are labeled as anything that is payable within 12 months. Fixed assets are held longer than 12 months. So your current assets, again, cash accounts, bank accounts, money markets, maybe you invest in some CDs. So those are basically your bank accounts or your quick liquidity, things that you have access to rather quickly and can turn that to whatever you need it to be. Receivables, accounts receivables. This is money that is owed to the business. Unless you collect cash for every transaction you do, every business will have some sort of accounts receivable. Receivables will not show up on a cash basis reporting. They are only going to show up as a reporting on an accrual basis. But I do have a little caveat to that. If they show up on a cash basis when they're really not supposed to, the only time they will is when there's a credit in accounts receivable, which means a customer has paid you more than you originally invoiced, or maybe your customer prepaid you before you invoiced. So that accounts receivable will show up on a cash basis reporting. Accrual basis, the difference is cash and accrual. Cash is when things are paid. Accrual is when they are recorded, not necessarily paid. So that's why accounts receivable will show up on an accrual basis report, but won't show up on a cash basis report. Receivables are one of those areas that you need to make sure that you closely manage and not let them get out of hand or left unpaid too long. That's your cash for your services or your goods. That's money owed to you. That's hurting your cash flow if you let that receivable sit too long. You've got to stay on top of those and really manage those receivables to keep the business healthy in cash and obviously maintaining itself and moving forward. Inventory comes next. Some businesses, service-based businesses, don't even have to worry about inventory. But if you're selling any retail products, manufacturing goods, that's your livelihood. That's how you sell your services and sell your revenue. You're going to have some inventory. Inventory can be one of those things that is a cash-eating machine in somebody's business if they're not paying attention to it. A lot of clients that I work with that do have inventory, they'll buy inventory rather than going back and checking. Like a lot of contractors are notorious for this. It's easier to go to Home Depot and buy the supplies than it is to actually go back and see, do we already have it? How much do we need? Do we have enough? Maybe we need a little bit, but they go in back and they buy for the entire job, realizing that they still had a bunch left. Inventory is one of those things that you need to pay attention to, and making sure that you understand that you have to have enough to sell for your customers' demand, but also knowing that you don't have so much in your inventory that you're sitting on a bunch of supplies. So it's a balancing act. I can't tell you that business owners that have been in business for years have ever really figured out their inventory. It is one of those ever-changing things. And also too, you need to understand that maybe you have seasonal periods. You have periods that, in the summertime, anybody that has summer services, they may have to buy a ton more during those summer seasons, but not buy as much during the winter seasons. And you may have to figure out in your business, what is your seasonal period? And that's going to take you a few years to kind of go through and understand your financials and understanding those quarters and the ebb and flow of those, the income and the expenses, and how does that work for you? And if I tell you, if I can, there's a couple pieces here. And if you can listen to anything I say when it comes to inventory, these are two very important pieces. Don't let that salesperson come in and tell you, hey, if you buy more than you normally do, you buy a bunch more, I'm going to give you a huge discount. You end up buying more than you probably need to save a few bucks. It's much better and certainly in small businesses that you order smaller orders more frequently, because then you can also, again, turn that cash more quickly. You're not letting that inventory sit on your shelves and hope that you sell it. When you're ordering, you know exactly what you're ordering. You know exactly what you need to sell to produce those, fulfill those orders and produce those sales. So again, you're turning cash flow. Your biggest thing here in any small business is, how can I get my cash and how can I get it the fastest? And keep using that method of, I've got to keep producing the cash and it has to keep coming in. Anything that delays the cash process is hurtful for a business. And then this last piece of advice, and take this because I am a tax preparer and I know how inventory affects tax returns. Don't go buy inventory. And I'm going to repeat this. Don't buy inventory at the end of your tax year. You are taking profits from your business and cash from your business that is going to sit on your shelves and has no added benefit to your tax return. There's nothing. You're going to pay tax on money that is sitting on your shelves. You're better off to buy some materials that you can use, prepay some expenses if that's what you're trying to do to drop down your tax liability, take some bonus salary, things that are going to affect your bottom line, or keeping that cash so that when you do owe taxes, instead of it being tied up in your inventory, you have that cash in your bank. You have to remember that your cash is it is your king. That is what you need to keep your business going. Keep producing cash and figure out how ways to not have it tied up. So again, like I said, please do not buy a bunch of inventory at the end of the year. The next section is the fixed assets. These are assets, again, that are held. They're not easily converted into cash, and you're holding these for longer than 12 months. These items can include buildings, land, equipment, furniture, leasehold improvements. If you've gone into your business and you've had to kind of revamp your business, paint, drywall, air conditioning, those are leasehold improvements. Those are long-term depreciable assets. And all these things are depreciable except for land. Land is a non-depreciable asset. It's, again, something that you've tied your cash up into a long period of time. And again, what is your end game? And can that land benefit you some way down the road? A lot of small service-based businesses may not get into some of these larger depreciable assets. And that benefits them because they're not tying up their cash. But it also, again, we have to keep an eye on those assets and liabilities because you're not not buying assets that you own. So you're not increasing your assets, but you may be increasing your liabilities. So the next section that I'm going to talk about is liabilities. They also have current payables, less than 12 months, longer than 12 months. So you've got your current payables and then your long-term liabilities. Liabilities are everything that the business owes to someone. Current liabilities are accounts payable, invoices from your suppliers, other bills that are not immediately being paid. Payables can be beneficial in your cash flow if you're using someone else's terms, your 30, 60, 90-day terms, to pay them so that you can in turn get your receivables faster. Again, how do I get the cash back in? How do I delay getting the cash out? Note payables, short-term obligations to investors, credit cards, lines of credit, payroll tax, sales tax. These are all current liabilities. You owe these either monthly or quarterly. So they're constantly, you have to keep those payables. And those are payables typically we'd like to keep within the 12-month period. Long-term liabilities, mortgages, bank loans, car loans. These are things that take you longer than 12 months to pay off. Final part of a balance sheet is owner's equity, also referred to as shareholder's equity. The label of an equity account differs depending on your entity structure. Sole proprietors are going to know owner's equity. Shareholders, those are going to be your S corps, your C corporations. Partners' equity, those are going to be equity in partnerships. So those labels change depending on your entity structure, but ultimately it boils down to owner's equity. So owner's equity consists of owner's capital. This might consist of paid-in capital, owner's draw, money that you've taken out of the business, and retained earnings. Retained earnings are this balance sheet, we say that it's from the beginning of the day of the business to the close of business. Retained earnings is an ever-rolling account from your net income and profit, from your profit and loss report, and then also your owner's compensation or your owner's capital and owner's draws. Those all roll into retained earnings. And the retained earnings is what I talk about being the positive or the negative net worth. So really, to recap today, the balance sheet captures the effects of operations in a period of time. The upper part of the report shows assets, what the company owns. Just under that is the liabilities, what the company owes. Both of these equal the owner's equity. Improving your balance sheet can consist of a couple different things. Increasing your assets faster than your liabilities. So you're again creating more of what you own versus what you owe, or just simply reduce your liabilities. Paying those things down to increase your net worth without changing your assets. Because again, some service-based businesses don't have assets. You can also increase your gross margins. What your services, how much you're charging your customers, how much you're charging your clients. You can increase, and that will produce produce cash, which is creating assets. So this is all flowing through, and part of tackling one on each podcast is to not overwhelm you, but also just understand how these all flow. Some things that you can make sure that your cash stays moving. Again, trying to produce more or hold on to it longer. Make sure that you're invoicing on a timely basis and stay on top of your collection process. Keep expenses as low as you can to preserve your cash. If you are looking for a loan, I want you to keep some do's and don'ts in mind. Do make sure that your bookkeeping is up to date and in good standing. If you can produce your bookkeeping, fine. But if you can't, get with a bookkeeper or an accountant, someone that does this for a living that can turn your books into usable financial statements for your loan as quickly as possible. Have accurate financial statements, both monthly and annually. You can't just walk in with one and expect them to understand your business. You're going to have to kind of show a pattern when you go for a loan. Be sure your personal finances are in order as well. Banks do care about both business and personal finances. Make sure that you keep your business and your personal bank accounts separate. Do not co-mingle. We hate this as bookkeepers and accountants. We hate trying to pull the personal expenses out of the business. And it muddles up the bookkeeping, and it really doesn't keep the separation that you ultimately thought you were setting out to do. So again, keep your business and your personal accounts separate. Know what your cash conversion rate is. How long does it take for you to pay your suppliers versus your customers paying you? Understanding what that conversion rate is can also help you be mindful of your cash. Understand when you're applying for a loan what you intend to use it for, and make sure that you have clear understanding of why you're getting this loan and what you intend to use it for. Make sure that you have a plan, again, to use it, and then a plan to pay it back. Some don'ts. Don't fight with your banker. It's not going to get you anywhere. You're going to leave with nothing. If your banker doesn't want to work with you, there's a reason your banker doesn't want to work with you. You need to understand what that reason is. Do what you can to change your outcome, and then also to maybe find somebody else. But again, don't fight with the banker. You're not going to win. Don't go to the bank without any of your financial statements. They're again not going to talk to you if they can't see those financial statements and understand that there's a pattern that's happening. Don't take on business debt at the same time you take on personal debt. That will affect you. The banker will look for those things. Don't borrow more than you truly need. Understand exactly what you're using it for. Again, goes back to that plan. What are you using these funds for? Have a plan to pay it back, and don't borrow more than you need. Borrowing money is not a bad thing, but if you need to understand and use it correctly, and again, have that plan to pay it back. So the next podcast I'm going to talk about is the profit and loss, the income statement. It's that speedometer on that car that we were talking about earlier. And we're going to understand how you can speed up your progression. You can slow it back. Again, your speedometer, you have, times when you need to slow down, times when you can speed up, times when you can just maintain. So you have to look at some of those and understand how those affect you, and when is the right time to, again, pull back or really speed up on your financials. So I'm hoping that this was all helpful. Again, like I said, I'm trying to break down and not make this overwhelming for people. But these are truly important financials that you need to understand in your business and understand how your money affects your business. So thank you for listening. You can reach me at Rebecca@yourcustombookkeeper.com, 253-514-8564. The podcasts are all listed on the website, which is letsmakeaprofitpodcast.com. So please, if you've missed any of them, go back and listen to any of those podcasts. Thank you for listening again, and have a great day.